Bloomberg Audio Studios.
Podcasts, radio, news.
Welcome to the Merryn Talks Money Weekly Roundup, our debrief on the biggest stories in markets and economics. I'm Merryn Somerset Webb, senior opinion columnist, and you're you. Get to your own line.
Oh, God, sorry. Yeah, this is terrible. I'm going to work.
They can't get used to this. It's
No.
the status.
And I'm John Stepek, Money Distilled author and senior reporter at Bloomberg.
Okay, got that sorted.
So professional.
I know, we're on this. John, you've been writing a lot of interesting stuff this week, and earlier this week you wrote about nervous, very nervous markets. You know, we're slightly at the point it feels where markets shouldn't be nervous because they know that we're on the edge of a cutting cycle, right? In the UK, we've already had a rate cut coming in the US. We know that 25 basis points is pretty much baked in, maybe a half, but definitely 25. So there we are on the cusp of this. It's supposed to be good news for markets. So I think Nick isn't such a twist about.
The proximate problem is that the non-farm payrolls. So the US labour market numbers were a bit worse than they thought. And I think that the problem is everyone was hoping you'd get a definitive answer from this particular bit of data.
So not great, but not so bad that it's definitely 0.5%.
Yeah, exactly. So it doesn't justify the Fed. It alone doesn't justify the Fed going full on, let's just slash rates altogether. And at the same time, it wasn't a particularly good figure either.
And we had some fairly but not quite right manufacturing numbers earlier in the week, didn't we?
Yeah, and I guess it's this other thing of the jobs data everywhere. I mean, particularly in the UK, it has been quite hard to parse compared to most of the other data. There's a general problem with people not responding to surveys because the kind of jobs data is largely gathered from surveys. And so basically no one's really got any proper idea what the labour market is doing. And so I think that's sort of adding to the whole thing. But then over and above that, you've also got the fact that the big stocks in the US are very expensive. And there's a lot less confidence in the artificial intelligence bubble propping everything up than there was maybe a couple of months ago. So I suppose it's just the market has been doing this fluctuation between worrying that there's about to be a recession and we're going to get taken by surprise, and then thinking actually everyone's going to be fine. And I think this is more just a continuation of that than anything else.
And it does feel like the AI bubble really has burst, doesn't it? And the conversations that I'm hearing at the moment are very different to the conversations I was hearing before. I mean, in our main interview this week, I talked to Mark Slater, and one of the things that he says when we're talking about a catalyst for the UK market, he says, well, do you know what? It's a lot easier to think of a catalyst for the UK market as a whole to go up significantly than it is to think of a catalyst for example, NVIDIA, as you've taught me to call it, NVIDIA, to suddenly go up another 30%. What on earth is catalyst for that? And another conversation earlier this week about energy and NVIDIA, and about if every single chip that everyone expects NVIDIA to produce and ship is produced and shipped, the amount of energy required to run those chips is off the scale. So once you start looking at all those other areas and attention is moving towards thinking about that kind of thing, it feels a little over, doesn't it?
Yeah, I mean, I guess it feels like the conversation changed at the point where a Goldman Sachs guy pointed out, the problem is we're spending a lot of money up front. And yeah, sure, the AI is going to change stuff in the long run. But at the moment, it's reliant on actually quite a small group of companies spending a shed load of money on building up their AI capacity. And as soon as one of them says, okay, that's enough, then the scope for NVIDIA's growth is kind of stymied, as they would put it in America.
Another thing that was pointed out to me, I had a lot of conversations this week. Another conversation about NVIDIA the other day was about the demand for its products, and saying that one of the interesting things about the market at the moment is that back say in the dot-com bubble, the majority of the small loss-making tech companies were listed. Remember buying all those, not me personally, obviously, buying all those ridiculous, small, unlisted, massively loss-making tech companies. Very much in the public eye. But this time around, a lot of the companies involved in high-level new technology, particularly AI, etc., are unlisted and hidden inside private equity funds, private equity companies, etc. We can't really see what they're doing. We can't really see whether that demand is sustainable. We can't really see the extent to which they will survive. There's an awful lot that we don't really know about the demand for the products of companies like NVIDIA. That's quite an interesting take.
It is interesting because you're right. the AI bubble's very narrow, and it's basically NVIDIA and nothing else, which is one reason why NVIDIA's gone up so much. But all of the fluffy .com style stuff is probably sitting in private equity portfolios where it can be extended and pretended for years
and it's
to come.
often sitting there at the wrong price.
Yeah, well, yeah, especially if that price is actually zero. I mean, you can only extend and pretend that something's not worth zero for so long.
Let's move on to what you've been writing about today. I think you've been writing about oil, right?
Yeah, the oil price has fallen a lot. It's like since April. I was looking at a chart and I didn't quite appreciate it. It's down over 20%. And obviously, if you look at the price of filling up your car, that's down a good bit as well, which is nice. Well, yeah, maybe not quite as much as the oil price itself, but the petrol price.
Nonetheless, cheaper driving is happy driving.
And the thing that's getting everyone worried, obviously, is the oil price falling because the global economy has actually hit a wall and we just haven't realised it yet.
We haven't noticed yet.
Or is it falling because there's just too much oil being produced?
Maybe we don't need it anymore because of the wind.
That I feel I can discount. It's not yet filling up the car with wind, sadly. But I was looking at the charts because the terminal actually is very good for this sort of thing, strangely enough. And US oil production. So the US is producing over 13 million barrels of oil a day at the moment. And that's nearly a record for the US. And it's also, if you look at what Saudi's producing about 9.2 million barrels a day. So to a lot of people still, I think the fact that the US is a bigger oil producer than Saudi Arabia will come as a surprise, even though that's been the case for many years now. And I do think this is arguably the most interesting geopolitical story of the past 2 decades, is the fact the US has gone from producing hardly any oil in the early 2000s to now being the biggest oil producer and also oil exporter, increasingly important in the liquefied natural gas market as well. And also, if you're looking for a clue as to why the US has done so well,
cheap energy.
Exactly. Nobody talks about it. And I think maybe that's because it's, America is a fossil fuel superpower.
Yeah. And there's more shale coming from other places as well, like Canada too.
Yeah.
Brazil. Other places.
Yes.
Do you remember the peak oil?
20
years ago, John, 15 years ago, I can't remember. We used to write articles about peak oil. God, I feel stupid.
Well, it was fashionable at the time. And I remember, I'm sure
we did not follow fashion. I'm sure I was first to peak oil.
We were the first to peak oil, just to be very clear.
But first.
Yeah, we were writing about it whenever it wasn't mainstream. But yeah, no, the idea we'd run out of oil. And obviously that did partly fuel the new sources oil that we've got. And I remember actually when we were writing about that, the idea that oil fracking was ever going to be a viable technology was still deemed to be a decade or more away. And that was when we first started writing about it in 2005. And actually it was already kind of on the way. It's a really good story about how human ingenuity does actually win out if you incentivize it properly. I mean, in the current case, I do think, or I've sort of concluded that, well, if the US is making record amounts of oil, then chances are the oil price is collapsing because there's just a lot of it.
Just a lot of oil, which is a great thing. Okay, John, speaking of pragmatism, the one thing that you and I are constantly concerned about is the UK stock market and its slow and rather miserable death, fall in the number of companies listed on every part of the market year after year after year, total dearth of new IPOs, even though we keep being told there's a flood of them coming. They never seem to turn up. There's a horrible valuation gap with the US in particular. Miserable levels of liquidity. Several people I've spoken to over the last few weeks been talking about why don't foreigners come and invest in the UK. They are coming bit by bit, of course, but one of the things that foreign investors say is there's just not enough liquidity there. We can't get in and out when we want to. So many problems with this market. And of course, I'm furious about the dumping of the British ISA. We talked about this last week because that would have sent a signal to the rest of the world that our government was serious about supporting the UK market. Now it kind of looks like they're not. But there is an enormous amount of chit-chat around this. There's a report out this week that I know you wrote about that are jammed full of good suggestions for the government to ignore.
Yes. Oh, it's interesting because we'll have to wait and see what happens with the budget, because I think the government wants to be seen as supportive, but I suspect that in net, they probably won't be. But one of the most interesting elements, there was a report about reviving the capital markets, and one of the pieces that fed into it was this piece by the New Financial think tank, which was basically just comparing what the UK's home bias is like compared to other countries. So basically, how much do we invest in our own stock market versus other stock markets? And the thing about this is that the UK is towards the bottom of the ladder when it comes to this. I think overall it was the UK pension system holds about 4% of its assets in UK equities, compared to Australia. In Australia, like, the overall superannuation system holds 25% in Australian equities. And the thing is, obviously, Australia is like a much smaller stock market than the UK's. In the MSCI index, the UK probably accounts for about 3.5%. So 4% that's not much home bias at all. Whereas compared to Australia, 25% versus, Australia must be about 1 or 2% of global stock market value. So that's much, much greater kind of bias towards home. And so the question then is, why has that happened? Does it matter? And how will we change it?
We don't really need to worry about the why, do we? And we can just say policy mistake, disaster, etc. What we need to worry about now is how do we fix it?
Yeah. One reason I would say that it's interesting to delve a bit deeper is because most of this is because still the biggest pot of assets is in corporate defined benefit pension schemes. And they're in rundown. So they basically get rid of most of their equity. Well, yeah, exactly. It'd be nice to have one, but they've got rid of most of their equities, and so they only hold about 1% of their assets in UK equities.
Okay, so they're busy liability matching, so they don't want to be in the equity markets.
And they account for about half of the British pension system's total assets, so they're a big, big thing. But the good news is that, it's mixed news because you can't have one, but it's good news because the thing that's replacing them, the defined contribution pensions, auto-enrolment, it already holds about 9% in UK equities. And that's going to become the bigger player over time. So gradually the bias away from UK equities should fall out of the system. Now, that's not to say that we couldn't accelerate that, and it's not to say that we shouldn't accelerate it. And I do think this is one area where a lot of the criticisms of the British ISA miss the point. The point isn't so much about supporting UK domestic companies or the economy. It's about supporting an actual functioning capital market. And so that means that, you can count a UK listed equity as anything that's listed in the UK. It doesn't matter that, it's a kind of miner that's got all of its mines in Egypt or something like that.
Or if it's an investment trust.
Exactly. The point is
just about the depth.
It's just, exactly, it's about the depth of the market rather than anything else.
Okay. So there is a lot of conversation about this, and possibly an expectation there's going to be a level of compulsion.
Yeah, I do wonder where are they going to bring that in. You've got companies saying that they'll invest 5% of you've got some saying they'll invest 5% of their assets in smaller UK companies, and presumably that would end up meaning like AIM stocks as well as the unlisted stuff.
Yeah, but if you're going to remove, which is another conversation, business property relief from AIM, so that AIM stocks no longer have the ridiculous level of unjustifiable tax relief that they currently have, then putting in place something to replace the liquidity that you'll lose as a result of that might be useful. Like, for example, the Brit ISA. If you took away the tax relief on AIM and put in a Brit ISA at the same time, that would be good.
Yeah,
that would be good.
Yeah.
Or if you took it away but also asked defined contribution pension funds to put a certain amount in at the same time, you could sort it out.
You could get away with it.
I'm rambling.
I liked your idea about ISAs low, because I thought that was quite scandalous, really, but also quite a good idea of basically getting rid of all the ISAs and just saying there's only one ISA and you've got to invest in British stocks to get the tax.
Now, if you did that and you abolished stamp duty at the same time,
yes, aye,
you'd send a massive signal to the world that the UK is genuinely open for business. Thanks for listening to this week's Merryn Talks Money debrief. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also be sure to follow me and John on X or Twitter @MerrynSW and John_Stepek. This episode was produced by Summer Sadi, production support and sound design by Moses Andam. Question and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.